Listen, I need you to understand something that's happening right now in the precious metals market, something that most people won't realize until it's too late. And when I say you have 3 days, I'm not being dramatic. I'm being precise. Right now, as I'm recording this, there's a window of opportunity that's closing fast, and I'm going to walk you through exactly why this matters, what's driving it, and what you need to understand before this window slams shut. Let me start with what's happening behind the scenes. The gold market isn't just moving on sentiment anymore. It's moving on fundamentals that are so powerful, so undeniable, that even the skeptics are starting to pay attention. We're seeing a convergence of factors that historically only happens once every few decades, and when these factors align, prices don't just move, they explode. Think about what happened in the 1970s. Gold started that decade at $35 an ounce. By 1980, it hit $850. That's not a typo. That's a 2,400% increase in 10 years. But here's what most people don't know about that move. It didn't happen gradually. The bulk of that gain happened in the final 18 months. People who waited, who thought they had time, who wanted to see more confirmation, they missed the majority of that historic run. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying the setup is eerily similar. And the 3-day window I'm talking about isn't arbitrary. It's tied to specific market mechanics that are unfolding right now. Let me explain what's really going on. The COMEX, which is the major exchange where gold futures are traded, is experiencing something that traders call a squeeze. Now, a squeeze happens when there are more contracts demanding physical delivery than there is physical metal available to deliver. And when that happens, prices have to rise to either attract more supply or discourage demand. There's no other way for the market to clear. Right now, we're seeing open interest in gold futures at levels that are historically extreme relative to the actual physical inventory in COMEX warehouses. The registered gold, which is the gold that's actually available for delivery, has been declining steadily. Meanwhile, the number of contracts representing claims on that gold has been increasing. This is a mathematical problem, and mathematics doesn't care about opinions or predictions. It just is. The 3-day window I'm referring to is connected to the options expiration cycle and the delivery period that follows. Without getting too technical, there are specific dates when contract holders have to make decisions. Do they roll their positions forward? Do they take delivery? Do they close out? And those decisions create pressure points in the market. We're approaching one of those pressure points right now. But the COMEX situation is just one piece of this puzzle. Let's zoom out and look at what's happening globally, because that's where this story gets really interesting. Central banks around the world have been buying gold at a pace we haven't seen in over 50 years. The World Gold Council reported that central banks purchased over 1,000 tons of gold last year. To put that in perspective, that's more than the annual production of every gold mine in the United States combined. And they're not slowing down. If anything, they're accelerating. Why does this matter? Because central banks don't buy gold for short-term trades. They buy it for strategic reserves. They buy it because they're preparing for something. And when you look at which central banks are buying the most, a pattern emerges. China, Russia, India, Turkey, Poland. These aren't random countries. These are nations that are actively working to reduce their dependence on the US dollar. There's a quiet revolution happening in global finance. It's not making headlines every day, but it's happening nonetheless. Countries are settling trade in their own currencies. They're creating alternative payment systems. They're diversifying away from dollar-denominated assets. And the one asset they're consistently moving into is gold. Now think about what this means for supply and demand. If central banks are removing over 1,000 tons of gold from the market every year, and that gold goes into vaults where it's not coming back out, that's permanent demand. That's not speculative. That's not hot money that can reverse. That's structural demand that changes the entire supply-demand equation. And here's where it gets even more interesting. The mining industry isn't keeping up. Global gold production has been essentially flat for the past few years. The easy gold has been found. The high-grade deposits have been mined. What's left requires more capital, more time, more energy to extract. And even with higher prices, you can't just flip a switch and produce more gold. It takes years to bring a new mine online. So you have increasing structural demand from central banks, flat to declining production from mines. And now you layer on top of that what's happening with investment demand. Gold ETFs, which had been seeing outflows, are starting to see inflows again. Retail demand for physical coins and bars is picking up. And institutional investors, the big money managers who had largely ignored gold for years, are starting to allocate again. I want to tell you a story that illustrates what happens when these forces converge. Go back to 2008. The financial crisis hits. Lehman Brothers collapses. The world is in panic mode. And gold, which had been trading around $700 an ounce, starts to climb. But it doesn't just climb steadily. It moves in waves. There are periods where it consolidates, where it looks like maybe the move is over. And then it explodes higher again. By 2011, gold hits $1,900. That's a 170% gain in 3 years. But here's the key detail. The people who made the most money weren't the ones who bought at the absolute bottom. They were the ones who recognized the trend early and stayed with it. They were the ones who understood that when fundamental forces are this powerful, short-term volatility doesn't matter. The direction matters. Now, let's talk about what's different this time, because every market cycle is unique, even if the underlying principles are the same. In 2008, we had a financial crisis caused by bad mortgages and over-leveraged banks. Today, we have something potentially more serious. We have sovereign debt at levels that are mathematically unsustainable. The United States has $36 trillion in national debt. That number is so large it's almost meaningless to most people. So let me put it in context. The interest payments on that debt are now over $1 trillion per year. That's more than the entire defense budget. That's more than we spend on Medicare, and it's growing. How do you service debt like that? You have two options. You either cut spending dramatically, which is politically almost impossible, or you inflate it away. You print more money, you devalue the currency, and you make the debt easier to pay back in nominal terms. And if you're a saver, if you're someone who's worked your whole life and accumulated wealth in dollar-denominated assets, that's a disaster, because your purchasing power gets destroyed. This is why gold matters. It's not because gold pays interest. It doesn't. It's not because gold generates cash flow. It doesn't do that either. Gold matters because it's the one asset that maintains its purchasing power over time when currencies are being debased. An ounce of gold bought the same amount of bread in ancient Rome as it does today. That's not true of any paper currency in history. Now, I want to pause here for a moment, because if you're sitting on $100,000 or more in retirement accounts, there's something you should know about. I've put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth checking out if that's relevant to your situation. But let me get back to what's happening in the market right now. The 3-day window I mentioned at the beginning is important because of how markets move. They don't move in straight lines. They move in steps. There are periods of consolidation where prices trade in a range, and then there are breakouts where prices move sharply higher in a short period of time. And those breakouts often happen around specific catalysts or technical levels. Right now, gold is sitting just below a major resistance level. If it breaks through that level with conviction, it's likely to trigger a wave of buying from technical traders, from momentum funds, from algorithms that are programmed to follow trends. And when that happens, prices can move very quickly. We're talking about moves of $50, $75, even $100 in a matter of days. But here's the thing about breakouts. They're hard to catch once they start. By the time it's obvious to everyone that a breakout is happening, the easy money has already been made. The people who profit the most are the ones who position themselves before the breakout, when there's still uncertainty, when it's not yet obvious. That's what I mean by a 3-day window. It's not that the opportunity disappears completely after 3 days. It's that the risk-reward changes dramatically. Right now, you can position yourself at prices that, in hindsight, will look like a gift. But once that breakout happens, once momentum kicks in, you're chasing. And chasing is how people make mistakes. Let me give you another historical example. In 2005, gold was trading around $450 an ounce. It had been in a bear market for 20 years. Most investors wanted nothing to do with it. It was considered a relic, a barbarous relic, as Keynes called it. But a small group of investors recognized that the fundamentals were changing. They saw the debt building up. They saw the money printing starting. They saw the imbalances in the global financial system. Those investors started accumulating gold in 2005 and 2006. And they were early. Gold didn't really start moving until 2007. But by being early, by positioning themselves before it was obvious, they captured the entire move. They bought at $450, 500, 550, and they held as it went to 1900. That's a 400% return. But the key was recognizing the setup before the crowd did. Now, let's talk about what could derail this, because I don't want to paint a picture that's all one-sided. There are always risks. There are always scenarios where things don't play out as expected. So what could go wrong? The main risk to gold right now is if the Federal Reserve somehow manages to engineer a soft landing. If they can bring inflation down without causing a recession, if they can stabilize the economy without having to cut rates aggressively, that would reduce the urgency for gold. But here's why I think that's unlikely. The Fed has never successfully engineered a soft landing when they've raised rates this aggressively. Never. Not once in history. Every time the Fed has raised rates by this much this fast, it's led to either a recession or a financial crisis. Sometimes both. The lag effects of monetary policy are long and variable. Just because we haven't seen the full impact yet doesn't mean it's not coming. It just means it takes time to work through the system. And even if they do manage to avoid a recession, which would be a miracle, they still have the debt problem. They still have the deficit problem. They still have the structural issues that are driving central banks to diversify away from dollars. Those problems don't go away just because the economy holds up for another quarter or two. Another risk is a strong dollar. Gold is priced in dollars, so when the dollar strengthens, it can put pressure on gold prices. But here's what's interesting. Gold has been rising even as the dollar has remained relatively strong. That's unusual. Typically, you see an inverse relationship. When the dollar goes up, gold goes down. But right now, they're both going up. That tells you the demand for gold is so strong that it's overcoming the typical currency headwind. What does that mean? It means when the dollar eventually does weaken, and it will because you can't run trillion-dollar deficits forever without consequences, gold is likely to explode higher. Because you'll have both the fundamental demand and the currency tailwind working in the same direction. Let me tell you about something that happened in the silver market that illustrates how quickly things can change. In early 2021, silver was trading around $25 an ounce. It had been in that range for months. And then, seemingly out of nowhere, it spiked to $30 in a matter of days. What happened? A combination of short covering, retail buying, and momentum traders all hitting the market at the same time. Now, silver came back down after that spike because it was driven more by speculation than fundamentals. But the point is, when markets are tight, when supply and demand are finally balanced, it doesn't take much to trigger a sharp move. And right now, the gold market is tight. The physical market is tight. The futures market is tight. Everything is coiled like a spring. And here's something most people don't understand about the gold market. The paper market, the futures and options, is much larger than the physical market. There are far more claims on gold than there is actual gold. It's like a fractional reserve system. As long as everyone doesn't ask for delivery at the same time, the system works. But if there's ever a rush for physical, if people start demanding delivery instead of just trading paper contracts, the system breaks down. We saw a glimpse of this during the pandemic. In March 2020, when everything was shutting down, there was a brief period where the futures price and the physical price diverged. You could buy a futures contract for less than you could buy a physical bar. That's not supposed to happen. It's an arbitrage opportunity that should get closed immediately. But it didn't, because there were logistical problems getting physical gold to where it needed to be. That was a warning shot. It showed that the paper market and the physical market aren't as connected as people assume. And if we ever get into a situation where there's a real scramble for physical metal, where people lose confidence in the paper claims, you could see prices gap higher in a way that's almost unimaginable. Now, I'm not predicting that's going to happen in the next 3 days, but I am saying the conditions are in place for something significant to occur. And when you're looking at a market that's this set up, where the fundamentals are this strong, where the technical picture is this constructive, you don't want to be on the sidelines waiting for more confirmation. Let me share one more story. I know someone who was watching gold in 2010. He understood the fundamentals. He knew the debt problems were getting worse. He knew central banks were printing money, but he kept waiting for a pullback. He wanted to buy gold at $1,200. It was trading at $1,300, and he thought, I'll wait for it to come back down. It never did. It went straight to $1,500, then $1,700, then $1,900. And he never bought because he was always waiting for that pullback that never came. That's the danger of waiting. You can understand everything correctly. You can have the right analysis. But if you're waiting for the perfect entry point, you might never get it. Markets don't always give you the entry you want. Sometimes you have to take the entry you're given. So, What does this mean practically? It means if you've been thinking about adding gold to your portfolio, if you've been considering it but haven't pulled the trigger, now is the time to make a decision. Not in a week, not after you see what happens next. Now, because the setup is here, the fundamentals are here, the technical picture is here, all the pieces are in place. And look, I'm not saying put your entire net worth into gold. That would be reckless. But having some allocation, having some exposure to an asset that protects against currency debasement, against financial instability, against the kind of monetary chaos that we're likely to see over the next few years, that's just prudent. That's just smart risk management. Think about it this way. If gold goes up 50% from here, and you have 10% of your portfolio in it, that's a 5% boost to your overall returns. But if gold goes up 100%, which is entirely possible given the fundamentals, that's a 10% boost. And if you have nothing in gold, you get none of that. You're completely exposed to the downside of currency debasement with no hedge. The 3-day window isn't about creating false urgency. It's about recognizing that markets move in waves, and we're at the beginning of what could be a significant wave. The smart money is already positioning. Central banks are already buying. Institutional investors are already allocating. The question is, are you going to wait until it's obvious to everyone, or are you going to act while there's still an opportunity? I want to be clear about something. I'm not a fortune teller. I can't predict exactly when gold is going to break out or how high it's going to go. Nobody can. But what I can do is read the fundamentals, understand the market structure, and recognize when the odds are heavily skewed in one direction. And right now, the odds are heavily skewed toward higher gold prices. Every piece of evidence points in the same direction. The debt levels, the money printing, the central bank buying, the supply constraints, the geopolitical tensions, the loss of confidence in fiat currencies. These aren't small factors. These are massive structural forces that take years to play out. And we're still in the early innings. So when I say you have 3 days, what I'm really saying is you have a brief window before the next leg of this move begins. And once it begins, once momentum kicks in, once the breakout happens, the easy money will be gone. You'll still be able to buy gold. You'll still be able to participate. But you'll be paying significantly higher prices for the privilege. This is one of those moments where doing nothing is actually a decision. It's a decision to remain fully exposed to the risks of the current monetary system with no hedge. It's a decision to hope that somehow, despite all the evidence, things will work out fine. And maybe they will. Maybe I'm wrong about all of this. But what if I'm not? What if the fundamentals play out exactly as they appear to be setting up? Can you afford to have no exposure to the one asset that's designed to protect against exactly these scenarios? The choice is yours. But the window is closing. The market is telling you something. The question is, are you listening?